stocks were taking a beating even before S&P downgraded the United States and the markets fell into bear territory. The Prudent Bear Fund bets against the market and is up about 15% in the past month alone. Ryan Bend is a portfolio manager with the Prudent Bear Fund, joins us now. Thank you for being here. The fund has done a good job of almost matching the inverse of the S&P when you look at a chart. What kind of returns are you seeing right now, especially in the last week as we've seen the sell-off in the equity market accelerate?
In the last week, we've done fairly well. Again, we've matched or slightly exceeded the inverse of the S&P, and we've done that through stock selection. A lot of the stocks that we've selected have gone down more than the market, and then also we have put options which have kicked in with the spike in the volatility. So we have had a good week, and we have outperformed the past week.
And looking at the sectors where you're particularly short, I see financials, also some technology stocks, and it's interesting the days we've seen the biggest declines for the broad equity market, we've seen huge declines for financials.
Right, financials have been very weak, especially the past 10 days or so, and that's really because these are stocks that tend to trade on fear and structural issues. When people want to get out of the market, they're usually the first ones that they tend to sell.
What sectors do you see continuing this decline in a significant way, and what sectors do you believe have possibly bottomed out here and are cheap and are due for a rebound?
We tend not to short energy. We're actually long gold and precious metal stocks. And on the short side, consumer discretionary is an area where we've started to get more involved. Those stocks have hung in there pretty well, so we're starting to dip our toe in there. And also healthcare, which is usually a defensive sector, but now because of all the issues with the federal government and we're probably going to have pretty big Medicare cuts, so healthcare is another area that we've started to increase our short exposure. And then financials and technology are areas where we're trying to go stock by stock and figure out where to take profit and where to press.
What do the wild swings, Ryan, that we've been seeing in recent weeks, what do those tell you about the direction of the market? Because I've got to say, I don't see any rationality behind it whatsoever.
Yeah, that's a very good question. I think there's professional investors all over the world are trying to figure that out. I think what we have a lot of levered players in terms of hedge funds. We have a lot of hedge funds are, well, we would say they're crowded in particular trades, so they're short dollar, long risk assets. And then when you have situations like you have in Europe, where now all of a sudden it looks like the euro might weaken, and so these hedge funds that were short the dollar, now they're having to unwind their trades, they're having to sell their longs, they're having to cover the short dollar. So you get these wild swings, and added to that fact, you have all these quantitative and program traders, and it makes for a very volatile market. And I think that's all we can really say.
Are there any fundamentals driving this market right now, in your opinion?
I think it's all macroeconomics. It has nothing to do with price earnings ratios and valuations. It's all macroeconomics. It's sovereign risks. It's France, Germany, Greece. That's really what's driving this market, and it's greed and fear right now. And a lot of people are trying to reevaluate how to value stocks right now.
For the average investor that's looking for direction, this is a terrifying market. Your call at this point, are we near some sort of bottoming out here?
I would not say that at all. You have a fair ways to go down here. So, in terms of recommendation, I would say, try to have a very balanced portfolio, and that would, could potentially include some, a short fund, but really, dividend-paying stocks, avoid beta, long, hard assets, and remember, cash is, at times can be your friend too. So if you don't have conviction in anything, there's nothing wrong with sitting in cash.
Obviously, you would advise people to invest in funds like yours. It's what you believe in. But what role does a fund like yours have in someone's portfolio at this point in time? What role does it play? How big of a position do you believe they should have?
Well, I mean, how we look at it is we think that you should always have an this is a separate asset class, so you should always have an allocation, maybe not a big one, maybe 5%, maybe 10%, but it helps dampen the volatility. It adds an additional alternative asset class to your exposure, and if valuations were high and you were very bearish, you could increase that. If you thought stocks were very cheap, then you could decrease it. But it's more a piece of the tool in the toolkit from an overall asset allocation standpoint.
Right.
is more how we're looking at it. If it looks like in the short term the market's going to run, we can ratchet back our short exposure, we can ratchet up our long exposure, and that way we try to not to lose as much when the market goes up, and then when the market goes down, we try to make more than the market declined.